For small businesses, maintaining accurate financial records is essential for long-term success. One of the most critical yet often overlooked aspects of financial management is reconciliation. Reconciliation ensures that a business's financial records match bank statements, credit card statements, and other financial documents. This process helps businesses track cash flow, detect errors, prevent fraud, and maintain profitability. Without regular reconciliation, businesses may struggle with inaccurate financial records, unaccounted transactions, and issues with tax compliance. Exploring what reconciliation is, why it is important, how to perform it effectively, and how it impacts expense tracking, will help in making informed financial decisions and overall business success. Reconciliation is the process of comparing financial records with external sources, such as bank statements, credit card statements, or vendor invoices, to ensure accuracy and consistency. Common types of reconciliation include bank reconciliation, matching business records with bank statements; credit card reconciliation, ensuring credit card transactions align with recorded expenses; accounts receivable and payable reconciliation, verifying that customer payments and vendor payments match business records; tax reconciliation, ensuring reported financial data aligns with tax filings. Reconciliation is important because it detects errors, identifies duplicate transactions, missing payments, or incorrect amounts, prevents fraud, helps catch unauthorized transactions or fraudulent activities, and maintains cash flow, ensures businesses have accurate financial data for better cash management. It supports tax compliance, ensures accurate financial reporting for tax preparation and auditing. It enhances decision-making, provides a clear financial picture to guide business strategies. Errors in financial records can lead to significant issues, such as misreported profits or undetected fraud. Regular reconciliation ensures that every transaction is recorded accurately, supporting sound financial management. A business needs a healthy cash flow to meet its financial obligations. Reconciliation helps small business owners identify discrepancies in deposits and withdrawals, avoid overdraft fees and bounce checks, ensure timely payments to vendors and employees. By accurately tracking income and expenses through reconciliation, businesses can identify cost-saving opportunities, detect unnecessary expenses, and maintain better control over budgeting and spending. Small businesses are often more vulnerable to fraud due to limited resources for financial oversight. Reconciliation acts as a safeguard by detecting unauthorized transactions, employee fraud or misappropriation of funds, banking errors. Small businesses should reconcile their accounts monthly or even weekly, depending on transaction volume. A structured schedule prevents discrepancies from accumulating. To start the reconciliation process, collect relevant documents such as bank and credit card statements, accounting software reports, invoices and receipts. Match business transactions with corresponding entries in bank or credit card statements. Look for missing transactions, incorrect amounts, or duplicate charges. Once discrepancies are found, take corrective actions such as contacting the bank for incorrect charges, adjusting accounting records for missed transactions, reviewing invoices and receipts for accuracy. Accounting systems like QuickBooks simplify reconciliation by importing bank transactions automatically, and matching transactions with accounting records, highlighting discrepancies for review. Accurate reconciliation ensures that businesses base their decisions on reliable financial data. This helps in planning investments and expansions, setting realistic budgets, and reducing financial risks. Regular reconciliation makes tax season easier by ensuring accurate tax filings, reducing the risk of tax penalties, simplifying audits with well-organized financial records. Lenders and investors assess a business's financial health before offering funding. Properly reconciled financial records enhance credibility and improve chances of securing loans or investments. For small businesses, reconciliation is a fundamental part of financial management. It ensures cash flow accuracy, supports expense tracking, enhances profitability, and ensures tax compliance. By adopting a structured reconciliation process and leveraging an accounting system, small businesses can maintain financial stability and make informed business decisions. Regular reconciliation is not just a bookkeeping task, it's a strategic tool for long-term success. Prioritizing it today will safeguard a business's financial health and growth for the future.